Morning all, how's everyone doing out there today? Thursday morning, we've got 2 days left before the end of the week. Time to pull out all the stops to get things over the line before you settle in for a relaxing weekend. Today's video is in response to a couple of questions asked yesterday by Rob Hooper. Thanks, Rob. In response to my video about stockpiling cash to be ready for the incredible opportunities that are coming our way in the property world. His two questions were, is it risky to be leveraged up to 75% on a property or perhaps across a portfolio more broadly? And what happens when interest rates go back up and costs go up, etc., etc.? Two really valid questions, Rob. They're relevant not just to yourself but the entire community, so thanks for asking them. I would refer you to the master here. So Simon Zutshi's book Property Magic is a gold standard for property investing. We're in his group right now. Thanks, Simon, for allowing me to engage with your community. I'm a graduate of the Mastermind program, and Simon's charted down 5 golden rules in his book Property Magic, which, Rob, if you and the rest of the community adhere to these, you're really very unlikely to go too far wrong. So let's just spin them through together and see what we all make of them, right? So number one is always buy from motivated sellers. So Rob, in essence, if you're dealing with someone that has a strong need to sell their property due to perhaps difficult personal circumstances, whatever the reason might be, you can work a really good deal. A win-win. It should be ethical, it should be in their best interests and yours, but effectively, if you can buy at a competitive price, then you're already pricing in margin for error from day one, right? Which de-risks the investment. And I think that your two questions all relate to risk. And in response, these 5 golden rules that Simon's put together are all about trying to de-risk things. So number one, keep an eye out, always be buying from a motivated seller. I'll give you an example. We did a deal last year buying from a lady who was getting divorced. She had 3 children. It wasn't a very nice home situation. She was really keen to move off and create a healthier environment for her children. And we were able to get a deal done at a fair price, nice and quick, and everyone was happy. So keep an eye out for buying from motivated sellers. Number 2, buy in an area with strong rental demand. This is crucial. If you're planning to buy and keep for the long term in order to generate passive income, which you can enjoy, and that's your goal, which it is for a lot of us in this community, if you buy and create a really nice asset that you then can't rent, you haven't got an asset, you've got a liability. And this has come to light massively in recent months with the drop-off in rental demand in certain areas. I know this all too well, owning properties near Gatwick Airport, where thousands and thousands of people that were our custom tenants have been made redundant, right? We had 10 rooms, I think, there. 6 people served their notice. Now, here's the good thing. There were other major employers in the area, and we've been able to tap into those markets to find replacement tenants. And it also helped that the quality of our accommodation was the highest in the, well, I'm saying that, I believe it was one of the highest in the areas because we did a big renovation project very recently. The rooms are in great condition, and we have been able to find replacement tenants where others haven't. So buy in areas with strong rental demand, but keep this in mind. Perhaps look for more than one major employer, perhaps 3, 4, 5, however many you can find, because if something goes wrong with one industry, then you can tap into other markets to keep things moving along. Number 3, buy for cash flow. All right, so the higher the cash flow, the bigger the buffer you have if something goes wrong. I'll give you an example. That 5-bedroom HMO I was just referring to near Gatwick Airport, I think the mortgage is £500 a month. The gross rent is £2,500 a month. There's some other bills in there. Let's say that the expenses, roughly speaking, are £1,000 a month, and that the gross rent is £2,500. Well, there's £1,500 worth of cash flow there. It's a strong buffer. So on those occasions where we did have someone move out, even 2 people, even 3 people move out, we're still going to be covering our costs each month. And that's the big difference. If you figure out a deal where you're getting a really healthy return on investment and really strong cash flow, you can fall a long way before you've got a real problem on your hands. So keep that in mind. If you're doing a typical single let on a 1-bedroom flat maybe, and the mortgage is 600 quid and the rent is 700, it doesn't take much for you to be in the danger zone. Whereas if you've got a really healthy cash flow, then you've got a lot of contingency in place. So keep that in mind too. Invest for the long term, buy and hold. Look, you're talking about property prices coming down. Let's take this as a really simple example. Let's say you own an asset worth £100,000. Let's say that the borrowing against that is at 75%, so 75 grand. And let's say the market drops 20%. I think it's very unlikely that it would drop 20%. And bearing in mind, whoever the bank is that's valuing your property, they don't want you to go into negative equity and for you to default on your loan. So they're only going to lend you a certain amount, and they're only going to lend you up to a certain LTV in a way to protect themselves, but also to protect you. But look, if it does drop, it's only coming down to 80 grand. If you've got a repayment mortgage going, your balance is coming down each month anyway. Obviously, a lot of us work on interest only, so that doesn't apply there. But essentially, if you've got a 25% buffer, it's pretty healthy. And if you're holding for the long term, well, over any 10-year period historically, prices have gone up, and they've gone up considerably, and I think that pattern will continue going forward, because at some point I think we're due a little inflationary bounce as a result of all this massive amounts of quantitative easing and money that's being pumped into the economy. I think about £750 billion worth of quantitative easing in the economy right now, with interest rates at an historic low. So I think that there's a bit of inflation coming down the track. So if you can hold for the long term, you can basically ride out the storm. And if you've got really good cash flow in the interim, and you've got a really good product, then you're likely to be able to ride out that storm, perhaps where others couldn't. And so as a final measure though, always keep a cash buffer. Things do go wrong. You're absolutely right to be asking these questions, Rob. Perhaps there's a few property people out there where it's all positive all the time, and it's all grow, roses, roses, roses. I can tell you, as a person that's been on the coalface for this for 10 years, that it is the best game to be in, but it's not always perfect, and things do go wrong, and you do have to be prepared for them. So if you keep a side account and you designate your amount of money that you think is a sensible contingency based on the size of your portfolio, well, it's there when there's a rainy day, isn't it? If things break, you can fix them. And sometimes when things break in property, they can be quite expensive, especially if you've got 5, 6, 10, 20, 30, 40 properties. You know, it's like if 3 boilers go at the same time, that could be 10 to 15 grand. So you want to make sure that you've got a healthy contingency for things when they do go wrong. So look, I'm not going to take any credit for this video. It all goes to Simon for putting his book together. If you haven't read it, I recommend you do. If you've read it 10 times, maybe read it 11 times, because we sometimes stray away from the basics, and it's good to be reminded of them. It's helped me shooting this video this morning to go through them again and make sure that I'm keeping them all in mind as things go forward. So I hope that's helped. If you guys have any other ideas on how you can de-risk investments, experiences that you've had in the last 6 months during this pandemic, where you've experienced things that you hadn't expected and how you've managed to cope with those challenges, I would love to hear them, and I think the entire community would benefit from that too. So please do comment below and share your thoughts. Wishing you all a lovely day, and I'll check in with you again tomorrow. Okay, bye for now.